think there's a real shortage. Actually, I know there's a real shortage. I mean, just look at what's going on in London. They're scrambling to be able to make deliveries. And it's just so important that people understand that if silver fails to deliver within 72 hours, you're not going to see markets open. Yeah, if markets stayed open, of course, the markets will level out. If China doesn't bend, and this is something my late partner Jim Sinclair used to talk about. He said uh, he could foresee the day where China would say, okay, gold's $50,000 an ounce. So if they peg the price or set the price at $50,000 or in yuan or whatever, but equivalent of $50,000, then what is the price worldwide? It's got to be $50,000, $4,000 gold or $5,000 gold, and China's buying it and selling it in whatever quantities you want at $50,000. That then becomes the price.
The global silver market is facing a serious physical supply strain. Leverage indicators, lease rates, and delivery pressures in London suggest that the paper metal market is under stress relative to physical metal. 1-month silver lease rates in London spiked above 30% in recent days. There's a genuine shortage of silver in London, where dealers are struggling to make timely deliveries. If silver deliveries continue to be constrained, the risk of market dislocations increases, backwardation, premium versus futures, delivery failures. Meanwhile, the gold price dynamics and surging Asian, particularly Chinese, demand fit part of the scenario in which global pricing could shift if one region sets a new benchmark. If China were to set gold at $50,000 an ounce, whether in yuan or dollar terms, that would instantly become the global benchmark. Bill Holter, a seasoned precious metals analyst and financial commentator, explains that the ongoing silver shortage could soon spill over into gold, triggering a broader market failure to deliver. In London, inventories are very low, and premiums are emerging for immediate delivery. Silver has outpaced gold in the recent rally. Industrial demand and investment demand are both strong for silver, which is unusual, and its supply response is constrained because much silver is a byproduct of other mining. Some analysts are warning of delivery and liquidity stress. Lease rates for silver have surged, and the spread between spot and futures is behaving in a way consistent with tight physical supply. If a major player like China were to assert a different pricing regime, by establishing a domestic benchmark for gold, and markets globally recognized it, that could force a dramatic realignment of gold and silver prices, and thereby affect fiat currency valuations and credit systems. The markets are always shifting. Don't fall behind. To keep ahead of the curve, subscribe and like this video. Please leave your comments in the space provided below. We would be very grateful to hear from you.
Well, first off, that will bleed over to gold, and gold will also fail to deliver. Understand that gold and silver have been suppressed. The prices have been suppressed literally for 50 years, since 1976 when they started with futures and options on metals. Understand that gold has been suppressed because it is the direct competitor to fiat currencies, whether it's the dollar, the pound, the euro, the yen, whatever fiat currency, gold is the direct competitor. Now, if let's say 10 years ago, gold didn't stop, or 15 years ago, gold didn't stop at the $1,900, $2,000 level, and it blew through, and it got to 4,000 like we are now, and then it moved to 6, 7, 8,000, and started spiking. What that tells you is it's not gold going up, it's the fiat currency that's losing value. So that spills out and it becomes a loss of confidence. And that would have and will prevent the U.S. from using a credit card with it would prevent or preclude the U.S. Treasury and other treasuries that borrow, but the U.S. in particular that has had an unlimited amount to borrow on the credit card, and thus we've got $38 trillion. It would cause interest rates to go up. It would just gum up the entire system, which would then gum up the real economy. But it would it would be extremely difficult for finance to continue as finance has continued because it's been a Ponzi scheme, uh, a Ponzi scheme of credit, and it would cast a dark shadow on credit, meaning, am I going to get paid back? People will be wondering about the credit system, and that's a problem. And you and I have talked about this before. Everything runs on credit. The entire financial system runs on credit. The real economy, everything that you touch, everything that you do every day has, credit has touched it in one way or another for that to have been created or be able to work. So it's important to understand that silver being such a small market, it's been very easy to manipulate. And they had to manipulate silver harder than gold because if silver ever got on hand, then gold goes. And if gold goes, then you have confidence breaking. And understand that you were talking about derivatives. It's a zero sum game in the OTC derivatives market where there's over $2 quadrillion worth of paper or contracts. The problem with that, because it's a zero sum game, if you have a huge winner, that also means there's a huge loser. And was that loss big enough to put the loser out of business? And if the answer is yes, then the loser can't pay the winner, which means the winner then becomes a loser also.
Right.
And that will spread across markets everywhere. That'll spread across credit markets. It'll spread across stock markets, equity markets. Interest rates will explode. That'll destroy the ability. Yeah, there's always a chance because you used the word for a while. For the end scenario, mathematically, no, they cannot fix this. They can't kick the can down the road. It's here. It's now. They're using their old tricks. They've raised margin on COMEX, which they've done many times before. They raised the margins and then forced the longs out because they can't afford the margin. They sell. I think the other day, in an hour's time, they sold something like 20,000 contracts. I mean, that's a huge amount of silver, and that silver does not exist. Remember, it's 5,000 ounces per contract, which I think that number worked out to be about 1 billion ounces were sold. The world only produces 800 million, 850 million.
Yeah.
And that's only $40 billion today.
Yep.
The global production of silver, even at all-time high numbers of $52, $53, is only just over $40 billion. $40 billion is a laughable number today. I mean, 15, 20 years ago, it was pretty big money. I can tell you back in the 1980s, early 1990s, the biggest takeover, the two biggest takeovers in the mid 80s was Texaco and I think KKR. One was 13 billion, the other was 25 billion. So yes, while the numbers are bigger today, but today you're talking about companies being taken over for, many times $40 billion. And there's plenty of individuals that are worth over $40 billion. Absolutely could set the price. I mean, think about it. If China has an official policy, let's use that number of $128, that they'll sell you, if the price becomes $128 in China, why wouldn't someone buy off of COMEX or buy off of LBMA and turn around and sell it in China?
Bill Holter describes a potential scenario where China could upend the global financial system by pegging gold at $50,000 an ounce. Such a move, he explains, would break Western gold paper markets, as massive contract losses would render both winners and losers insolvent. Holter warns that this time, there's no way to save the system. The end game. He says it is near. Let's get into the details of the interview for further insight.
Yeah, if markets stayed open, of course, the markets will level out. What will happen is they'll find a medium, and if China doesn't bend, and this is something my late partner Jim Sinclair used to talk about. He said he could foresee the day where China would say, okay, gold's $50,000 an ounce. It's bid at 50,000, it's offered at 50,000. What do you want to do? So if they peg the price or set the price at $50,000 or in yuan or whatever, but equivalent of $50,000, then what is the price worldwide? It's got to be $50,000
Mm-hmm.
because that's the market. I mean, money is going to flow where it's treated best. And if the West is at $4,000 gold or $5,000 gold, and China's buying it and selling it in whatever quantities you want at $50,000, that then becomes the price. The problem with that is if you jacked up gold prices 12-fold from here, or it wouldn't even have to go 12-fold, it could go less than 100% from here to break. That would break the contracts. That would break the market itself because like I said, for every winner, there's a loser. And can somebody lose 12 times their money and stay solvent? No, they can't pay the winner. Then the winner's a loser. And then the people who are doing business with either the winner or the loser knows they're both dead. You're going to do business with them? You're going to trade with them? No. And that's I mean, I'm not looking at this and saying, I think this is what could happen. This already happened back in 2008, 2009 with the Lehman Brothers problem. And it took, and think about this, it took only $700 billion in TARP and another, what was it, 16, 17 trillion that we found out 2 years after the fact that the Fed sprayed all over the world, more than half of that to foreign central banks to keep the system floating. And think about how crazy people went over the $700 billion. I mean, people were wringing their hands for 3 or 4 days because $700 billion is a crazy number. Well, $700 billion is like a broken potato chip that falls out of your pocket now. Who's the white knight going to be? I mean, 16, 17 trillion is not going to fix the problem. Who's going to step up and save the ECB? Who's going to step up and save the Bank of Japan? Who's going to step up and save the Fed? Now, I mentioned the ECB, Bank of Japan, and the Fed. Guess what? They all have negative equity. They're all technically insolvent because the bonds that they already own are underwater to the point where their equity has already been wiped out. I believe this is the rally you don't ever sell. It doesn't matter. I mean, if silver goes down $5, $10, whatever, gold goes down $200, $300, $500, who cares? Because you can see the end of the road. You can see the end game. And the end game is either you have metal. When I say metal, either you have capital or you don't. And when this system breaks and the next system starts, you're either going to start with capital or you're going to have to start all over again. So don't get cute. Don't think, okay, silver hit $53 today. I'm going to liquidate it. And in a couple months, when it's $45, I'm going to rebuy it. The problem with that is we may not get out 2 months and we go through a failure to deliver. There is none. Your silver has already been sold, and you're just like everyone else with money in the bank that just got wiped out through the great taking. So I do want to caution people of trying to be cute and liquidate and trade this. This is not the rally that you trade because we are at the end game.
What do you think? Could China realistically reprice gold to $50,000 an ounce? And if so, how would that instantly disrupt Western paper gold markets and global financial stability? With silver lease rates spiking above 30% and delivery pressures intensifying in London, are we approaching a tipping point where the paper and physical markets finally decouple? If you appreciate this video, please hit the bell button for timely updates, subscribe to the channel, and like the video. Also, leave a remark with your ideas. We value your presence and thank you for your support.